Good day, traders. This is the daily market update live from the Tradelo trading floor. It's Thursday, the 11th of April. Some highlights from today's show. Iran strike imminent. The dollar is going to start breaking things and the ECB is behind the curve again. Let's get into it then. So let's begin off with some of the key observation takeaways from yesterday's session. It stood out like a sore thumb. The US dollar soared. It's now broken out to yearly highs. It's broken out of the recent, 6-month range that it's been stuck inside, and it's set to start breaking things. Strong dollar is never good for emerging markets. A strong dollar typically creates some significant borrowing financing issues for most of the world. So keep a really close eye on that strong dollar. We continue to see appreciation. It's going to start to cause havoc. Now, notable, obviously, the BOJ's come out again. We are seeing particularly the yen move very, very weak against the dollar. So just keep an eye. A strong dollar, there's always going to be ripples as a result of that. And we saw some of those ripples yesterday. VIX closed on 16, one of the highest closes this year. It's the first time the market hasn't really been capable of crushing that VIX back down. So keep a very close eye. We should see that VIX today perhaps pop up 17, 18, 19. And depending on how crazy things get, don't forget, once we get above that 20 point, all hell should break loose, particularly in the risk markets. Okay, that in mind, the other thing that was a key standout yesterday, we had the US 2-year yield effectively rising 21 basis points. At the same time, gold finished the day mostly around the flat mark. Sure, it was up at some point and then down and up at some point. Finished the day down a little bit, about $8, $9. The point is though, to see that sort of outperformance from gold when the 2-year yields are up 21 basis points is significant. It tells us that exactly what the market thinks about the inflation report, which is that it's sending the signal that the Fed is making a mistake by not prioritizing getting inflation under control. And that's why we're seeing the gold up the page. What that means is that gold is always going to be a buy on the dip until such a point that the Fed reprioritizes inflation rather than just saying we'll get inflation back over the coming years. So that's then the rundown takeaway from yesterday. Next up, very important, Middle East. Some tensions have risen. We got some commentary overnight that effectively the allies have put Israel on alert that an imminent strike is coming from Iran or Iran proxies. That is keeping the market a little bit nervous. We obviously did have a dollar rally in the oil market as a result of that. But what's key to take away is we're still down on the week. So even though we are seeing escalatory talk about an Iran strike, we're still well below last week's highs and we're still down on the week in terms of oil. So again, take it with a pinch of salt. Yes, the market bid up, priced in a little bit of that geopolitical risk, but every single time we don't get that strike, at some point that positioning could come unstuck. Okay, so keep a very close eye. Sure, the market is on tenterhooks just in case there is an escalation. And keep in mind, should Iran actually strike and it comes from Iran into Israel territory, that's a bit of a game changer. That really does shift the goalposts. For most of this year, every time there's been some escalation, the market has shrugged it off. Why? Well, because there's a tendency to believe that Iran barks a lot more than it bites. Okay, so that's the market's thinking. So should there be a strike, you do not want to be fading oil. You do not want to be fading anything for that matter. We should see a very strong continuation of this dollar theme, a very strong bid in oil, and a very significant sell-off in particular risk markets. Okay, now let's get into the highlighter today. It's ECB. It's all about the ECB. And the way to think about the ECB is let's take a step back and have a look at the minutes that we got just over a week ago from the ECB. And what the ECB ultimately told us is that whilst inflation is moving towards progress, what's important for them is they just want a little bit more data in the coming months. Okay, and that's what the market kind of took away from it, is that they're growing confident about this idea of a rate cut coming in the near term, but they're wanting to get just a few more data points. And specifically, Madame Lagarde in the Q&A referenced June as the potential starting point because she believed that would give her a sufficient amount of or sufficient number of data points to really conclude that wage dynamics and particularly wage inflation was not going to be a problem and cause any second round effects for inflation. Now, very, very, very importantly, okay, going into this meeting, what data have we had since the previous ECB meeting in March? Well, one, we had inflation data that came in quite a lot lower than expected. It was quite a big miss in inflation. And we also had a BLS report that came out just earlier this week that really does point towards a very significant slowdown in Europe. And what the ECB survey was saying was that corporate loan demand declined substantially in Q1, contrary to expectations for stabilization. In other words, keep in mind, Europe was already stagnating. Okay, the ECB told us in March that they're only expecting 0.4% growth this year. Now, if loan from corporate demand has dropped off a cliff in essence, what that means is that very likely Europe is already in a recession. And in fact, the ECB is going to have to revise down that yearly growth forecast, perhaps to zero or even negative. Okay, now the ECB is well aware of this. They would take that BLS report and they will be discussing that today. They do not want to be late on the curve. Again, keep in mind, the ECB was late when it came to starting the process of hiking, and they're very aware of making that mistake again. Now, what that means for today is that there is no expectation for a rate cut today. In fact, there's only one economist out of 65 that expects a rate cut today. So I would definitely want to be watching for that. Whilst it's an outlier, do not rule out the ECB cutting today. Okay, they very much, if that BLS report means something, and if the CPI miss means something to them, they may well want to get ahead of the curve. Why? Well, because what Madame Lagarde also told us at the Q&A in March was she said to us, we're not going to wait for inflation to get to 2% before we act. We just want a little bit more confidence. Now, remember, the Fed came out earlier this year and started to talk about a dual mandate where they focus on both inflation at 2%, but also ensuring that they get that coveted soft landing and not put the economy into recession. The ECB is no different. Sure, they mandated to target 2%, but they don't want to tip the ECB, or they don't want to tip Europe into recession, because then what it means is we'll start to see deflation. In other words, negative inflation. And that then becomes very problematic for the ECB. So keep that in mind. We may well see that shift today, and we may actually see that rate cut come from the ECB. If they do not cut today, they will be very strongly hinting at the first cut coming in the June meeting. Now, that's pretty much expected, okay? The June cut is priced. It's around 20 basis points priced. The expectations for the ECB this year is to cut at every other meeting when the ECB revises their forecasts. So right now, we've got 3 rate cuts priced from the ECB. However, and this is crucial to understand, if the ECB believes that the economy is slowing more than expected, that they're perhaps already in a recession, and that in actual fact, inflation will reach their target ahead of the start of next year, what they may well do is signal that every single meeting is live. And that will be taken as quite dovish. Why? Well, because like I said, the market only expects them to cut at every other meeting, which is every, in essence, 12 weeks. And if we are getting a significant deterioration, 12 weeks is a great amount of time to be waiting before acting. Okay, keep in mind, and this is very crucial to understand, is that if the ECB cuts 25 basis points, but inflation is disinflating, in other words, we're actually seeing it below target already, what happens by keeping rates higher or by only cutting, for example, 25 basis points is that policy is actually becoming more and more restrictive, even if the ECB does nothing or even when they cut 25 basis points. Okay, and this is this concept of being behind the curve. The ECB doesn't want to wait for inflation to be disinflating before they begin the process. Otherwise, they'll be forced into cutting more aggressively, like 50 basis points or even more. Okay, so keep that in mind. It's very, very important. What is the one thing you want to pay attention to today is, does Madame Lagarde signal to the market what a potential rate cut cycle could look like? Okay, the expectation, like I said, is a cut at every other meeting. So listen very carefully when she characterizes what the ECB is thinking is on the rate cut path. Are they going to go every meeting? In other words, do they expect that once they begin, they'll begin the process of 25 at every other meeting, and they're not going to just wait for the staff macroeconomic forecast? If the answer is yes, we are going to get a very dovish reaction. Now, let's talk about where you want to be trading today. Okay, the Q&A, the statement obviously is the first thing to pay attention to. If there's any tweaks in that statement, it will be to the dovish side. They're not going to signal something hawkish today. So any tweak to that statement, the market will have an initial dovish reaction from that. You should see particularly the front-end bonds bid up, as well as the euro extend on yesterday's lows. Now, the Q&A is kind of going to be where the key is going to come in, because the market believes the Fed's going to cut in June, and the market believes the ECB is going to cut in June, and that's not really news. What is news, like I said, is Madame Lagarde, are you going to cut at every other meeting? Is every meeting live? And if she answers yes, what she's confirming to us is that the ECB is confident that inflation will get to 2%, but they're also concerned about the current growth trajectory. Okay, so keep a very, very close eye. That's going to be key to interpret. And then unanimity. Okay, that's very, very important. Was there unanimous decision on the ECB today? One of the questions you can expect is, Madame Lagarde, did you guys discuss cutting interest rates today? Right, listen very carefully how she answers that. If she says there was a very broad, strong discussion about perhaps considering cutting today, what she's almost doing is telling us that it's guaranteed they'll cut already in June. Now, again, that's not unexpected. Okay, well, like I said, the market expects the beginning June. But if they're already talking about cuts today, what it means is that June and July are both live meetings. So again, the market will perceive it as dovish because, like I said, right now, there's only 3 cuts baked in for the ECB this year. Now, markets to trade, let's finish with that. 2 markets you want to pay attention to. Obviously, in Europe, the front end of the bond curves, whether it's the OATs or the German Schatz, that's where you want to pay attention to. Why? Well, if you have a look at the Schatz chart, particularly yesterday, you will notice that it got dragged. In other words, yields got pulled up by what we had from the United States. And again, what that means is that we've broken out to yearly highs in the Schatz in terms of yield. And so should we get that dovish sort of signaling from the ECB by telling us, yes, we could go at every other meeting, that Schatz will take out a lot of that positioning that got into the market yesterday. However, the cleaner play, the easier trade is in the euro today. Why? Because remember what I said, the dollar is on the front foot and it's going to start breaking things. Why? Because guess what? Mr. Fed is not likely to begin the process of cutting in June, and they may not even begin the process of cutting rates this year, which means we've got divergent central bank policy. Now, whenever you see this, if you go look at the playbook of divergent central bank policy, you will always get very clear-cut trending moves in the currency space. It's why the currencies are back in play. You want to be looking to be long dollar, short euro today. And like I said, if Madame Lagarde does signal every meeting's live, you can expect that euro to not just break yearly lows, but we should begin the process of moving down to 105 support, thereafter towards parity again. Okay, so that's the key focus points today. That's the ECB. There's a lot going on. What I would say to you is just make sure you pay attention to all the different moving parts. Like I said, VIX at 16, the ECB coming out and being a little bit more dovish, plus the tensions in the Middle East. All of it does really set us up for a very volatile trading session. So be switched on, be alerted, make sure you manage that risk and go make some money.